Hello, welcome to CMD Oral Space Forest lesson. This is a special class, a special video, a special episode for our advanced Forex trading lesson. So in the previous video, we promised that we are going to treat trading strategy. But because of some inconvenience that I'm experiencing, I have problem with my PC. So all the backup and the information is there, right? And I can access the data on that. So I'm actually using a new PC and I don't have that information. So that data is something that I've prepared for myself, a strategy. So a trading strategy is something that you don't develop, you don't write them up in one day. So it actually takes the whole of your trading journey. So I have information of it, but for presentation, I don't think I can do that in a video without showing you some data. So I decided to put that on hold and then and treat some other topics whilst I find a way for that. So if you are here, we are going to treat correlated pairs. So I have even told you about that we are going to treat such topics like this. So trading strategy, currency pairs, and then profits, and then trading supply and then demand zone. So whilst I wait for that information, let's take the opportunity to use the time. So that is it. So we are going to treat correlated what pairs in terms of currencies. I think in some other aspects, the same idea, you can what look at that, you can utilize that. So for the disclaimer, in fact, whatever you are going to do in this video is not a financial advice. Like I say, always, you have to check these things with your risk tolerance or any financial advisor that you can get. We are only here to educate you and then try to help you together go together. So that is our main intention. Now, for another thing, when I was making the research and then writing down things, I find the information, I think, more precise and then accurate and then in simplicity, right? Very simple. On myfx.com, I told you I use that page, that site. It's very good, very convenient. Myfx.com, and then there's this new site that I've also discovered called CMC Markets. I think they are profen. So for that acknowledgement, I think they also have a good site, and then you can check it out from there. So whatever I'm going to do, the information are on this site, these sites, myfx.com and the CMC Markets. I think they are proven. So you can look it up. I think later on, maybe if you want more information about it. So let's not waste time about this. I'll try as much as possible to keep within a video maybe 20 minutes. So if it's getting more than 20 minutes, then I'll do in part 1 and 2. So thank you very much. Now, first of all, what is a correlated pair, or what are correlated what currencies or pairs or instruments, right? So I'm going to read and then explain in simple terms. Now, currency correlations or forex correlations are statistical measure of the extent that currency pairs are related in value or move together. So the key notes here, the key points here is in value, and then if they move together. So correlated, but the idea is if the currency move together or in that magnitude, right? We look at them in something called coefficients and then the direction. So that is it. Now, let me just give you a recap or a recall of what I've been saying in my weekly analysis, right? Especially about EU and GU. That's Euro USD and then pounds USD, and then sometimes I go to the commodity called what? The gold or the metal. So I tell you always that in this profession, you have to look at, or you have to look out for your what? Your niche. So as you start as a newbie, you find ways to what to make yourself better. You won't be a better or be the best of yourself in one day. It actually takes a period of what years, yes, a period of time. So that's what you have to look at. So with my journey, I learned and I traded all the major pairs. We got to a time that I found my niche with EU, right, and then GU, and then sometimes what gold. So that is it. So the idea of me trading only EU and GU is something that I discovered in the term called correlated word pairs, right? So I try to trade or open positions of the same type. When I say type, if I'm buying all the pairs. If I'm selling all the pairs. This gives me the what? The edge, the higher probability chance of what? Winning. So that is it. So with correlated pairs, we look at one side of it and the other side of it, right? It can be advantageous and at the same time disadvantageous. It's based on how we use it. So that is our main aim for this episode or these episodes, right? So we are talking about what? Values in magnitude and then in direction, right? So now, if two currency pairs go up at the same time, this represents a positive correlation. Don't worry, I will explain better with more explanation. Now, if one appreciates, right, and the other would depreciate, this is what's called what? Negative correlation, right? So let me just give you information ahead. EU and GU are positively correlated. That is why I trade them and I use the same type of position on them because they are positively correlated. They move together and they're not always in the magnitude, right? As in the prices, the level that they rise. Let's say EU is at 1.2354. It doesn't mean GU will also be at 1.2354. But the number, the magnitude can be around the same price, but not actually the same thing. But then when it comes to the direction, you can see that looking at the two charts at a go in real time, right? These pairs are generally buying or selling at the same time. So that is what we call correlated pairs. So you can see that we can have advantage there. And then if in another sense, if disadvantage, it depends on how you use it actually. So now let's go. Now, understanding and monitoring currency correlations, right, is important for traders because it can affect their level of risk, right, when trading in Forex markets. Now, in this article, right, we look at how Forex correlation is determined, calculated, how it affects trades and then trading systems, whatever you see. So that is what we are going to look at, right? So we are going to see how best as a trader, you can use this terms, but you understand the correlated pairs, how best can you use them? In fact, whatever you do in your trading journey, it's high time you understood what you are doing, not a situation whereby you watch and then you just apply. You see, no, you have to watch, learn, and understand, right? So if you're a newbie or intermediate, in fact, you could be an advanced level. These things will not actually come to bear. You wouldn't have the proper understanding of these things. So that's what we are going to look at. You have to understand. So how can a trader actually use this term to the advantage? So that is it. So let me take it again. From here, it says something like understanding and monitoring currency correlations is important for traders because it can affect their level of risk when trading the Forex market, right? So that is now. Let's go on. Now, let's have the term actually. Now, what is correlation in Forex trading? Now, Forex exchange correlation, right, is a connection between two currency pairs. A connection. What happens? What can you see when at the time, in real time, what is happening? What can you infer from the chart, the price actions? So that's what we are talking about. Now, there is a positive correlation when two pairs move in the same direction. Positive when two pairs move in the same direction. Now, it didn't say in the same direction and magnitude, but the main focus here is on the direction because every forex trader will have to utilize what the market is, what the trend, what is happening at a goal, right? What is happening at that current time. So we are mainly based on what? The direction of the market. So two pairs, EU for instance, and the GU for instance. So they are positively. Don't worry, you look at them, you understand them. So it's a positive correlation between two pairs move when they move in the same direction. Now, a negative correlation when they move in opposite directions. So what it means is that EU will be buying. Then another example that is real is USD CAD, right? USD, the US dollar against the Canadian dollar, right? So EU will be buying, GU could also be buying, but USD CAD will be selling. So when it happens this way, then there's a negative correlation. Now, there's one formula trick that I give all the time that let me give you a formula. The formula like XXX. The XXX means any other currency at all. Every currency pair is in what? They are pegged, right? The term is PEGGED, pegged. For them to get a currency pair. The pair means two different currencies coming together, right? So that is, so when you combine these two, then let's say EU and then GU. EU, that's EURUSD, is one pair, and then pound USD is also another pair. So when I give the formula like XXX stroke USD, it means the XXX is any other currency against the EURUSD. Then another formula would be like the USD stroke XXX. So you look at the position on which side is the USD, and then yes, you understand, and then which side is the other currency. So that is it. So when I give XXX, right, USD, it means that if dollar is what? Buying, XXX USD, if dollar is buying, then this currency actually will be what? Will be selling. Then that will be the vice versa. So that is it. So don't get it twisted. I will still put that formula in the description so that you have a better understanding of this. So if you look at EURUSD and then USD CAD, you see they have negative correlation because looking at the position of the USD in those pairs that we are talking about, they are different. So that is why you see that I always trade EURUSD because USD is there on the right, and then when I take pounds USD, pounds is still on the right. So that means they could be positive for me. In fact, yeah, in that direction. So that is why I always worry you by saying I trade EU and GU for this reason. So this is the reason that I do that. You understand? So now, whatever if you have been following me or listening to me, I'll many a time say something, then later I'll prove to you why I do these things. I don't do things, I don't teach in abstract sense, right? Even though I may attack some topic which may seem vague in the beginning, but later, if you follow critically, I'll come back to explain because we are learning. So I think you are following. So that is the idea, right? Now, just let me take it again and just let's go. So a foreign exchange correlation is a connection between two currency pairs. Now, there's a positive correlation when two pairs, example EU and GU, move in the same direction, and a negative correlation when they move in opposite direction, like EURUSD and then USD CAD, right? So, and then there's a time that no correlation if the pairs move randomly, right? Randomly with no detectable relationship, right? So, example like let me see, EURUSD, right? We have EURUSD, then we have Australian against the what? The Canadian dollar, right? This has different. In fact, there's no correlation between them because there's no common currency among these pairs. Listen to me again. EURUSD and then Australian dollar against the Canadian dollar. These two pairs have no correlation, or the correlation between them is random. It means that there are times that they could move together, in another time that they could move what differently. So that is the idea. Now let's continue. Now, currency correlation is important for traders to understand because it can have direct impact on trading and forex trading results, often without traders awareness, right? So if you trade any pairs at all without having understanding of the nature of that economy, the nature of that currency, you many a time lose. You understand? So that's why if you're an amateur or a beginner, your mentor would tell you that, okay, now try and trade all the major currency pairs, like 8 of them you're selling. Then with time, you see that you are doing well, right? You are doing better in this aspect with the help of what? Your trading journal. You just treated that. So that's the title, training journal. That's another important topic that we treated recently in the advanced playlist. You can watch that. So that is it. So with that data, you get to know which currency pairs that you are most profitable with or in. So you understand. So that is it. So everything is just coming to bear. Now, as an example, assume that the trader buys 2 different currency pairs that are negatively correlated. The gains in one may be offset by losses in the other, right? Which is often used as a hedging strategy. Meanwhile, buying 2 correlated pairs may double the risk and profit potential. Don't worry, let me read our explain. Since both trades will result in loss or profit, right? Since both trades will result in loss or profit, they are not fully independent since the pairs move in the same direction. So what we are talking about is, let's say now we have seen the most correlated or the positive ones, right? Now we are looking at the other side whereby we have a negative correlated pairs, right? Let's say the Euro USD and the USD CAD. These are negative. They are negatively correlated. Don't worry, we have a chart. Maybe probably in the second video, episode 2. Right. So a situation whereby you have a negative correlated pairs. There's another term called hedging strategy, right? Hedging strategy is a situation whereby a trader tries to cover up his or her losses with another positive position, right? So there are many a time. In fact, this is a broad topic, but I will just cover it briefly here. So there are times that the trader would not like to lose entirely. Let's say on 2 positions, they don't want to lose entirely, losing here and losing there. They don't want a situation they don't want such a situation. So they try to use one position to cover up for their losses. So let's say Euro USD is buying, or yes, is buying at the moment. Then they'll go and enter a sell, right, on USD CAD. Why? Because these pairs are negatively correlated. So one pair will be in a profit and another will be in loss. So when there is a loss, they'll use the positive or the profitable trade to cover up, their assets. You understand? So that is another term. But for me, for instance, I have come to understand my pairs a bit, not 100%. I've come to understand them with patience and proper risk management. So I don't think I've gotten to the level, or I really have to worry myself doing hedging strategy. I don't need that. Of course, you may need that. So it's good you learn this. In fact, you have to learn everything. Then you will decide how to apply them. So I hope you understand me. So that is it. So use one to cover one loss to cover one profit. One profit to cover another loss. So that is another thing. So that's why I said from the onset that even correlated pairs, the positive and negative, could be used as a tool. How you want it, how you actually want to apply them. So I hope you are getting the picture now. So that is what's important. So let's end the video part 1 here. Right now, I'm trying to make videos very, very short, right? at least 15 minutes in the video, or at most 20, 25 minutes in an episode, then continue from the other, so that at least you have time and then watch and then come back to the part one if you are a busy person, a busy type. So thank you very much for this episode. We meet in episode 2, and then we'll continue, and then I'll show you from here, and I'll show you the charts. That is it. So thank you very much for watching. See you in the next episode. Bye.